It's Andrei.Hall, America's retirement asset distribution professional.
I take great pride in going above and beyond for my clients and utilizing strategies to maximize what you get in retirement while at the same time potentially minimizing taxes to ensure your money will last.
And here's Andrei.Hall, America's retirement asset distribution professional.
Hello, it's Andrei.Hall, America's retirement asset distribution professional. Today, we're going to talk about Social Security planning, what baby boomers need to know to maximize retirement income. When your parents retired, they probably didn't think too much about Social Security. They just went down to their local office as soon as they turned 65 or maybe 62 if they retired early, and applied for benefits. They took their benefits for granted and didn't ask very many questions. But baby boomers are approaching the Social Security question in a very different way. Most people tend to minimize the value of Social Security. If they understand that they are likely to get something back from the system at all, they think it will only be a minimum amount, not really enough to count on. But Social Security is far more valuable than most people realize. First, Social Security is one of the few sources of income you can't outlive. If you're worried about running out of personal assets in your old age, you need not have that fear with Social Security because it continues until the day you die. And of course, the longer you live, the more you will extract from the system. If your benefit starts out at $2,000 per month, and if you live 10 more years, you will receive nearly $300,000 in lifetime benefits. If you live 20 more years, you'll receive over $600,000 in lifetime benefits. And if you live 30 more years, you'll receive over $1 million over your lifetime. This assumes annual cost of living adjustments or COLAs of about 2%. Second, Social Security offers annual inflation adjustments. So if your benefit starts out at $2,000 per month, and if annual COLAs are 2%, in 10 years, you will be receiving $2,438 per month. In 20 years, your benefit will go up to $2,972. And in 30 years, your check will be $3,623 a month. There is no way of knowing exactly what future COLAs will be, but 2% seems to be a reasonable estimate. When your Social Security benefit is calculated, it will be based on how much you earn over your working career and the age at which you applied for benefits. The formula for calculating Social Security is pretty complex. You may or may not want to follow along with this. Some people find the formula interesting. In a moment, I will show you a couple of ways to estimate your own benefits. The general process goes like this. First, Social Security looks at your annual earnings over your entire lifetime, indexes them for inflation, and picks the 35 highest years of earnings to include in the formula. The index earnings are total and divided by 35 to come up with an average. If you don't have 35 years of earnings, the missing years will be filled in with zeros. This has the effect of lowering Social Security benefits for people who have taken time out of the workforce, for example, to raise children. However, they may be eligible for spousal benefits, which we'll cover in a moment. Next, a formula is applied to your average indexed monthly earnings to determine your primary insurance amount. This is the amount you will receive when you reach full retirement age, which could be 66 or 67 or some age in between. Each year, COLAs are applied to your benefit to help you keep up with the cost of living. Here is an example of how the benefit formula will work for a baby boomer who was born in 1960 and who earned the Social Security maximum every year since the age of 22. His average indexed monthly earnings would work out to be $11,430. In calculating his primary insurance amount, the first $1,024 would be multiplied by 90%. The amount between $1,024 and $6,172 or $5,148 would be multiplied by 32%. And the amount over $6,172 or $5,258 would be multiplied by 15%. These amounts would be totaled to come up with a PIA of $3,357. This is the amount the worker would receive at full retirement age. I told you this was complicated. Fortunately, you don't have to figure this out yourself. Full retirement age is the age at which you can claim full unreduced benefits. It used to be 65 for everyone, but now we are seeing a higher full retirement age being phased in as a result of the 1983 amendments. For everyone born between 1943 and 1954, full retirement age is 66. For everyone born in 1960 and later, full retirement age is 67. For those born between 1955 and 1959, full retirement age is 66 plus some number of months. Now remember that I said earlier that your primary insurance amount, or PIA, is the benefit you will receive at full retirement age. So what happens if you apply for Social Security before full retirement age? Well, your benefit will be reduced. You will receive a percentage of your PIA depending on when you apply. If your full retirement age is 66 and you apply at age 62, you will receive only 75% of your PIA. That's at 63, 80%, and so on. If your full retirement age is 67, you apply at 62, you will receive 70% of your PIA. These amounts are actually prorated monthly, so you can apply anytime after the age of 62, and your benefit will be reduced by the appropriate amount. On the other hand, if you apply for Social Security after full retirement age, you will earn delayed credits of 8% for each year you delay. So if your full retirement age is 66 and you apply at 67, your benefit will be 108% of your PIA. At 68, it will be 116% and so on. At age 70, you can't earn any more delayed credits, so it doesn't pay to wait until after age 70 to apply for Social Security. I'm guessing you're probably not too interested in calculating by hand your AIME and your PIA and the reductions in credits for early or late filing, or the annual COLAs that could raise your benefits in the future. So you can find out approximately how much you can expect to receive in benefits in one of several ways. One, you can refer to your annual Social Security statement. Simple. These are now available online at www.socialsecurity.gov/myaccount. You will need to set up an account by answering a number of security questions. Two, you can use the retirement estimator on the Social Security website. This calculator taps into your specific earnings history after you enter your personal identifying information, including your birthday, Social Security number, and mother's maiden name. Don't worry, the site is secure. Please note that the annual statement and the retirement estimator do not factor COLAs into your age 70 benefit. This means your actual benefit will likely be higher than they indicate. But the calculators at Hall Wealth Management, we do adjust for COLAs. So if you know your PIA, we can help you project your future benefits. The decision of when to apply for benefits is one of the most important and most complicated. It can literally make a difference of thousands of dollars over your lifetime. Before we get into the number crunching, it's important to realize that the decision when to apply for Social Security depends on many factors unique to your situation. These include your health status, your life expectancy, your need for income, whether or not you plan to work, and if you are a surviving spouse, whether you have other personal resources. The when to apply question is very complex and really requires a customized analysis. But here are a few points to remember. If you apply early, your benefit starts out at some fraction of your PIA, 75% or 80% or whatever. It remains at that percentage for the rest of your life. It does not go up to 100% when you reach full retirement age. COLAs magnify the impact of early or delayed retirement because the annual cost of living adjustment is applied to either the lower or the higher amount. This causes the disparity to increase with each passing year. The when to apply question impacts survivor benefits as well. High earning spouses are therefore encouraged to delay benefits to age 70 because that will give their surviving spouses the highest benefit after they die. Let's look at some strategies for maximizing benefits. The first thing you can do while you still have time is improve your earnings record. First, check your annual statement to make sure your earnings record is accurate. Mistakes are rare because the earnings kept on file at Social Security were reported by employers when they submitted your Social Security taxes. But mistakes can happen, especially for self-employed individuals whose earnings records are taken from tax returns. The next thing is to consider how you might be able to improve your earnings record. If you do not have 35 years of earnings, can you work a few more years so they will not be filled in with zeros? If you had several years of low earnings early in your career, can you work a few more years now while you are in your peak earning years so those low earning years will be replaced with high earning ones? Even if you start receiving Social Security and continue to work, your earnings record will be updated. Strategy 2 for maximizing Social Security is to apply for benefits at the optimum time. We've been making a case today for delaying benefits because that will result in the highest lifetime benefit for you and your surviving spouse. But there is no one-size-fits-all answer to this question. The important thing is to apply at the time that is optimum for you. One important consideration in deciding when to apply for benefits is whether or not you plan to work. If you apply before you turn full retirement age and you earn more than the $19,560 in 2022, $1 of benefits will be withheld for every $2 you earn over the $19,560 mark. Now, it's important to know that this money isn't truly taken away. Rather, your benefit will be adjusted upward when you turn full retirement age to make it as if you had applied later. This means that if some of your benefits are withheld due to the earnings test, your new benefit will be higher as if you had started at 63, 64, or 65 instead of 62. Please don't let the annual earnings test discourage you from working. The more money you earn, the more money you will have. Social Security does not penalize you for working. Once the adjustment is made, you will end up with a higher benefit for the rest of your life. Just wait until you are full retirement age or later to apply for benefit. Strategy 3 for maximizing your benefits is to coordinate spousal benefit. The goal is to maximize income for the both of you while you are alive, and maximize income for the survivor after one of you dies. It can be quite complicated, but by understanding all the considerations and doing some calculations, it's possible for married couples to come up with the right solution for their needs. Did you know that part of your Social Security benefits may be taxable? Strategy 4 for maximizing your benefits is to minimize this tax. You can minimize taxes on Social Security by lowering your other income, especially investment income. But you should be aware that municipal bond interest, which is usually tax-free, counts as income for the purpose of calculating the tax on Social Security benefits. Anticipate the required minimum distributions from your IRA, which may cause you to be in a higher tax bracket and may cause some of your Social Security benefits to be taxable. Consider drawing down IRAs before age 72. Consider converting a traditional IRA to a Roth IRA, which generates tax-free income. Delay Social Security in order to reduce the number of years benefits are subject to tax. Reduce your expenses, pay down debt, and adopt a simpler lifestyle so you can make do with less income. And continue to manage taxes throughout retirement, not just the first few years. As always, please consult with your own tax advisor about your individual situation. Strategy 5 for maximizing Social Security benefits is to coordinate Social Security with your overall retirement income plan. It is important to consider Social Security in the context of your other retirement resources, including pensions, IRAs, and 401ks, the required minimum distributions you'll be needing to take at age 72, your overall investment portfolio, and your plans for working in retirement. All of these resources should be coordinated to give you the income you need for the rest of your life. Please don't be afraid to ask for help. Retirement planning is easy when it's a matter of stashing part of your salary into a 401k or IRA. But when the time comes for you to convert your nest egg into an income stream, you want to make sure it doesn't run out. Social Security may be the bedrock of your retirement income plan, but it must be coordinated with your other resources to give you the stability and security you deserve. You have questions, we can help. We've covered a lot of ground today, but you probably still have questions. When should you apply for Social Security? What if you keep working? What if you've already applied? How much will your benefits be? How can you coordinate spousal benefits? What's the best long-term strategy for your situation? What should you do next? We would be glad to help you consider each of these questions individually and help you come up with a plan for your own personal situation. Hall Wealth Management has been providing clients with guidance on exactly how to protect their nest egg and maximize income in retirement for over 18 years by utilizing cutting-edge technology that takes out most of the guessing game. I hope today has made you realize that Social Security is too important for guesswork. I look forward to talking with you soon.
Thank you for watching. We hope it was informative. If you'd like to have a personal one-on-one Social Security overview with Andrei.Hall, America's retirement asset distribution professional, you can click on the scheduling link. If you'd like to also receive Andrei's official weekly financial newsletter, please feel free to enter your email address. Thank you.